Hey everybody, this is Jose here. We are ready to start the session. I had a little bit of delay on my side, so we're starting with 5 minutes delay. But if you guys hear my voice, so this will be a sound test. If you guys hear my voice, we are now ready to get started. So please confirm that you hear my voice. Sound check. Please confirm on the chat box that you hear me. Thank you so much. Hey Marcus, how are you? Very good, perfect. Okay, so let's get started with our session. Today we're getting together for sharpening, isn't it? So today we're gonna be talking about important trading material to put in place to produce the desired results. Pedro, how are you, my friend? Very nice to see you here. Ahmad, how are you? Orlando, very nice. So anyway, let's launch our session. June 29, 2019. Welcome to the session. My name is Jose Blasco. I will be your guide. Today we are getting together for sharpening purposes, sharpening our skills as professional traders or investors or anywhere in between. And before we start, as always, we need to go over the disclaimer. So let's do this quickly so we can begin. Disclaimer: the following videos, clips, and demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that happens obtained through the next week is the first week of the third quarter of the year, so obviously important times. Okay, but anyway, talking about important times, today is going to be an important time in the sense that we are going to begin the process of taking options to the next level. Okay, so there are multiple advanced applications of options that we haven't explored yet. There are interesting ways on how to switch the trading mode from regular trade to the match control mode when a trade goes against us. And all of this, of course, implies the use of a little more advanced options combinations, option strategies, and these obviously imply the proper understanding and the proper use of something known out there as the options Greeks. Okay, so today, my intention in today's session is to have everybody understand what matters about the Greeks. Okay, understand options Greeks, understand what matters, understand better why we look into the Greeks, why we use the Greeks to accomplish certain goals, so we all understand what that means and how to use it. Okay, now the first thing I would like to say as we begin the session today is that when someone who is not an expert on options Greeks or has not traded options for too long, when someone hears that in options there is something called options Greeks, to be honest, I don't know if the person who gave it the name wanted to do this on purpose or what, but the fact is that most people feel very intimidated because it sounds Greek, right? And it's like, oh my God, so what are the Greeks? And then, if you were to give the explanation of those Greeks from the point of view of Mr. Blacks and Mr. Scholz, which were two amazing mathematicians which in 1985 won the Prize Nobel of Economy because of the statistical model that they develop when it comes to options pricing, and the Greeks and some of the Greeks that are more complex than others, if you wish, because some Greeks derive from other Greeks. So or listening to me right now, the way I'm explaining it, it really sounds quite complicated. Okay, and most people are a little bit turned off by the Greeks, and basically most people end up not even trading options because they feel options are very complicated or complex, and it's not the case at all. Okay, and the fact is that it is really not the case. Of course, we do need to spend some time talking about it, and you may need to spend some time with yourselves thinking about it so you get a greater, deeper understanding. But the fact is that it's not complicated at all, as you will see. Okay, so today we're going to talk about Greeks. Okay, and whatever your language is, obviously we use English in these sessions, but whatever your language is, we will make the Greeks to sound like in your own language. Okay, that's the idea. So that way we can utilize those Greeks as powerful measurements to assess certain things that may be happening to our trades, or even more importantly, certain things that may be happening to our portfolios, and therefore manage either trades or portfolios based on a deeper understanding of what's happening to our trades. Because if you don't use the Greeks, okay, the only thing that you could look at to decide if you want to stay in a trade or you want to leave a trade, it's the price of the stock, right? If you trade stocks, or the price of futures if you trade futures, or the price of the currency if you trade forex. But with the options, okay, we have those beautiful Greeks, which we need to explain, that they look at different things, they measure different things, and if you were to understand them, it makes a massive, massive difference. Okay, so please, everybody, be with me. Okay, believe me, it's worth it. Okay, so everybody, please be with me in diving deeper into the Greeks, and you will tell me at the end of the session. But my intention is to run today's session in a way where at the end of the session, everybody understands the Greeks and the Greeks are not Greek anymore. Okay, that's the intention. Okay, at the end of the session, please feel free to tell me if I accomplished my goal or I didn't. Okay, and maybe someone will need to rewatch the session, which will be recorded, and it's okay. But I would anticipate that maybe it's not even needed. Okay, because I want to keep it very straight to the point, very direct, and more than explaining what are the Greeks, talk about how to use them. That's the key, because if you understand how to use them, indirectly you understand what they are. Okay. So anyway, it's like driving a car, right? So you could learn how to drive a car by someone giving you a massive lecture on how engines works, or you can learn to drive a car without no one explaining much about engines. And after a while, that now you have experience driving cars, now let's have a massive lecture on engines, okay? And what happens now? Your level of understanding of engines is way better because you had some experience driving them, even though while you were driving them, you didn't have full understanding, okay? So this is kind of like what I've been doing during these few last months, if you wish, where a few months ago, I exposed you to critical and very powerful information related to options, but we never talked about the Greeks, okay? We just mentioned them. We never dove deep into them. Today, that's what we're gonna do, okay? And it's gonna be, as I said, quite simpler, okay? So again, we have a TradeStation chart here, okay? This is just because later I'll need to use the charts, and I will load also an option chain. So later we can also have options data. But really what I need to utilize, at least to begin the Greeks, okay? What did we say in the past? We said options Greeks, they are like different types of meters in a car dashboard. That's what we said, okay? It's like you're driving the car, right? And you're looking at the dashboard and it says, hey, you're driving 100 kilometers an hour, okay? Or 60 miles an hour, depending on the country in which you are, right? So that's a speedometer. It measures the speed. The speedometer doesn't tell you how to drive, but it tells you the consequence of your driving. And given how you're driving and therefore the speed at which you got the car going, you may decide it's time to slow down or it's time to use the throttle even more, right? And accelerate, right? So the speedometer is going to be the Greeks. Okay, we're going to have 5 types of meters, okay, like temperature of the engine, temperature of the oil, the speed of the car, the RPM for the engine. We're going to have different meters, okay, and these are going to be the Greeks, which you probably remember from the prior lesson that we had, that we got 5, which is delta, gamma, vega, theta, rho. Okay, and again, the reason why they are known as Greeks is because 4 out of 5 of those words are actually letters from the Greek alphabet. Delta, gamma, theta, rho are letters from the Greek alphabet. Vega is not. Okay, but it sounds like it. So somehow for the people that we don't speak Greek, so to us this sounds Greek, right? And next thing you know, it became like a normal thing in the options industry to call them the options Greeks. Okay, maybe they should be called the options meters. Okay, or maybe they should be called something different. I'm not sure what would be the best name. Okay, but they are known as Greeks. Okay, again, let's go ahead and find a right spot here on my Word document so we can continue typing a little more, okay, and diving a little deeper into this. Okay, so again, I just said it, we got 5, we got delta, let me do this, we got delta, we have gamma, we have theta, we have vega, and we have rho. Those are the 5 Greeks, okay? If you were to apply those Greeks to a trade, okay, so let's say you plan a trade with Alibaba, okay, and you decided to use 20 September expiration and you decided to buy the 170 call. Okay, so if you decided to do that, okay, and if you were to insert this in your analysis tab by clicking on analyze by and then click single, then you can see here, okay, on this particular tab where I have been given, let me make sure I got everything correct here. So I'm gonna select last, so it's the last price. So I have in the bottom part of, oh, what just happened there? Oh, it changed to Tesla, got it. So let's go back to Baba. Yep, sorry for that. I don't know where I clicked. Okay. So anyway, so here's the call I just inserted. Okay. So I have in the bottom part, I have my positions and simulations. We talked about the Option Station Pro the other weekend, isn't it? So you know how to use this tool now. In this case, I am buying one of the Alibaba September expiration 170 call. This is what I'm buying, right? And when I add this, okay, apart from this tool giving me the option to take the trade thanks to the button that we have on the right, you know, this tool is very nice, and also giving me the option to look at the graph on the top, which is also very nice. What I want to check now, oh, that's very interesting how it keeps switching to Tesla. So what I want to check now is really it's what's happening in the middle part, okay? Because in the middle part, what you can see is that I got the 5 Greeks, the delta, the theta, the gamma, the vega, and the rho. And I would like to use this example to go over these Greeks, because that way we would kind of understand the Greeks in motion instead of understanding the Greeks simply from a theoretical point of view, okay? Okay, thanks for that. I see your comment, John. Thank you very much. So again, so we have our Greeks, right? So now, again, also important to know that the Greeks I am pointing out, which I haven't explained yet, they are linked to the specific price for the stock, okay? So the current price for Alibaba, as you can see on the upper part of the screen, is 169.8. So if I select the option from the drop-down menu as last, automatically TradeStation will force the value on the left to be the last, which is the same value as on the top. Therefore, when I get my meters, my Greeks, the delta, the theta, the gamma, the vega, and the rho, those Greeks, okay, are related, directly related to the current value of the stock, which is again 169.8. So let me pause. Okay, let me pause. Remember, we said the Greeks are like meters. Okay, for example, the speedometer in the car dashboard. They measure the speed of the car. Okay, so in other words, the Greeks are measurements that measure the speed of the option. Okay, in this case, it's a call, but at the same time, in this case, we have like 2 steps, if you wish, because in the case of the speedometer of a car, then you just measure the speed of the car, and what you drive is the car. But in this case, we are not driving the stock. We are driving the option that derive its value from the stock. So we are trading the call. The call is the car. We are trading the call, okay? And the Greeks measure the speed of the call, okay? But we also know that the call derives its value from the stock. Okay, so we have 2 moving parts every time we trade options. The first moving part that we have, actually we have multiple moving parts, as you know, but the first moving part that we like to discuss is the price of the stock. The price of the stock may move up and down. And when the stock moves up and down, in this case the stock is Alibaba, when the stock is moving up or down, this will have a direct impact on the value of the call or the value of the put if I had picked a put. The option, call or put, derives its value from the stock. Okay, that's what we know since a long time ago, because this is very basic. Options are a derivative product. We know that. So the question is, do they move with a relationship of, let's say, 1 to 1? Do they move with a relationship of 1 to 1? Meaning, if the stock moves 1 from 169.80 to 170.80, right? So if the stock moves $1, does this mean that the current value of the option, I'm going to use the midpoint, okay? Does it mean that the current value of the option, which is 10.95, will become 11.95 and will also move by 1, okay? That's the question, okay? We know options move in tandem with the stock. They are derivative assets. If the stock goes up, the calls will gain value. If the stock goes down, the call will lose value. But what speed is that? Okay? Do they move at the same speed as the stock? Right? That's the question. And the answer is no in most of the cases. Okay? The only time where an option moves exactly at the same speed as the stock is on the expiration date, assuming that the stock is in the right side of the strike, and therefore the option is deeply in the money, and therefore at that very moment on expiration date, the price movement of the option equals the price of the stock. But that's only on that day, on the expiration date. Before the expiration date, the options track the value of the stock, but it's not a one-to-one relationship, okay? There is a difference, okay? And how do we measure that? Well, we measure that with delta, okay? That's how we measure it. Delta measures, okay? That delta is one of the speedometers that we have on our car dashboard, and that speedometer is going to tell us how fast the option will move as the stock moves. That's what delta is. Delta is a measurement of speed of profitability or speed of loss, okay? One way to think of the D for delta is think about D as direction, in the sense that if the stock doesn't move, then the option would not change value, okay? If the stock moves up, then the option would gain value. If the stock goes down, then the option will lose value. And the question is, at which speed, okay? So in this case, is 54, as you can see, in the case of the delta. What does that mean? That if the stock goes up, okay? So if the stock goes up by $1, okay? And remember, every option represents 100 shares. So let's pretend you are long 100 shares of stock. So if you are long 100 shares of stock and the stock goes up by $1, you would experience a profit of $100. Okay? Where in the case of the call, would move by $54, not by 100. Okay? The call would move by $54.01 to be precise, but it will not move by 100. Okay? In other words, probably one of the easiest way to think about what delta is that delta represents a percentage, okay, which tells us the speed of change in the P&L. Correct. I need. Okay, 1 second, guys. So P&L. Interesting. I cannot get my and. Okay. So let me type it on the Word document. Maybe it's even better. So delta, okay, represents a percentage, okay, a percentage number, which reflects, okay, I got my, this is a little bit of a mystery, isn't it? Keep switching from Baba to Tesla, that's quite funny. Okay, anyway, so delta represents a percentage number which reflects the proportion, okay, which reflects the proportion by which the option price will change, and the options price changing reflects the P&L, right? Given a move on the stock. This is what this is, okay? So in other words, if you have a delta of 54, okay? Think about, let's do some math. If your delta is 54, okay, if your delta is 54, I just said delta can be seen as a percentage that represents the proportion of the profit given the move of the stock. So if the stock moves by 1, because you have 100 shares, right? Remember, we need to create a proper equivalency. Every option is worth 100 shares. So to look at an equivalency of what a stock position would do compared to an options trade would do, you will need to multiply times 100. So if the stock moves by 1, that will produce a change in the P&L of $100 if the move is up, or a change of the P&L of minus $100 if the move is down. So how much, okay, how much is 54% of that, right? So if the stock moves by 1, that would be 100, right? We said that before. But if you have a delta of 54, okay, delta of 54 equals that you will make 54, you will make or lose 54% of what the stock would. So if the stock would provide $100 of profit if the stock moves up, or $100 of loss if the stock moves down, 54% of 100 is 54. Okay, and that's the number we just got there. Okay, so when you do your simulations, okay, when the quantity is 1, okay, 1 means 100 for stocks, okay, or in this case 54 for delta. If the quantity of stock Alibaba. So if the quantity of stock instead of 1, if the quantity of calls instead of 1, I make it 2, okay, this would be 200 for stocks. And now your delta becomes 108, which is 2 times 54. So again, this is going to be a percentage that tells you what proportion are you benefiting or suffering from if you were to compare the options trade compared to a stock trade. So if the stock trade is going to pay you 100, 54% of 100 is 54. If the stock was 200 shares, and therefore a move on the stock of $1 was going to pay you 200, right? And your delta is 108, so that means that you will produce 108% of 200, which is you will produce 54% of 200, which is $108. Okay. So in other words, putting on the side that I'm reloading the option chain on the screen, okay, and hopefully this is not too distracting for you. So what I'm saying is that delta represents a percentage where that number shows you the speed at which you profit from a stock move. The higher the delta, the more you are exposed. Okay, so delta is a measurement of exposure. Delta is a measurement of exposure. In the world of stocks or futures, you measure your exposure by looking at the position size, right? The bigger the position size, the bigger the exposure. If you are long 500 shares, you have more exposure than if you are long 100 shares. If you are long 6 futures contracts, you have more exposure compared to being long 1 future contract, right? So exposure in most markets is measured by the position size. In options, okay, is not exactly position size, because in this case, so take a look. I'm going to use Tesla, so it doesn't keep switching. It's quite an interesting thing to see. So what I'm going to do, I have Tesla here. So I'm going to, again, do something similar I did before. So I'm going to look for September 20 and pick the at-the-money strike, which is the 220. Oh, that's amazing. You just switched to Alibaba. So we'll continue working with Alibaba. So for example, in here, in my first case, okay, if I check mark okay, if I check mark this single option where I buy one of the 170 call, it gives me a delta of 54. Let's say I wanted to have an exposure equivalent. Let's say I wanted to have an exposure equivalent to 500 shares. So what would I do? Okay, well, I would probably buy 10 calls, between 9 to 10 calls. 9 to 10 calls would give me an exposure of delta 540, where a delta 540, okay, it's equivalent to around 500 shares, 540 to be precise, okay? But also, notice that if I was, instead of using the 170 call, I was to use the 185 call, okay? So if I use the 185 call, let me uncheck the one above. If I use the 185 call, this one, okay, notice I'm pointing at one, okay, and I'm looking at the 185. This is the only one I have checked, okay, because the one above is unchecked, okay? So because the one above is unchecked, the delta value I got here, which is 32, that is for the 185. In other words, the 170, I'm sure you remember, gives you 54 delta, where the 185, as you can see, give us 32 delta. So remember, coming back to the dashboard thing, the deltas are telling you the speed of profitability as a percentage of the participation you will get from the stock movement, and therefore it's equivalent to the position size. So what does that mean? It means that the option below the 185 call is an option that has less participation built in. It's an option that profits at a slower pace, where the option above is an option that has more participation built in. It's an option that participates at a higher speed. Okay, and by the way, the people who trade options, obviously, they are very intelligent people, and therefore they price options accordingly. When you see options with less participation for the profit, okay, less speed of movement, so what happens? The price of the option is 513, but when you see options like the one above, which has more participation, so what happens to the price? It's more. It becomes 1095. So the higher the delta, the more the price. Okay, the lesser the delta, the cheaper the option. Okay, so of course, the cheaper the option, the better the trade from the point of view of how much you paid. But also, the cheaper the option, the less the delta. So you may find yourself in a position where the stock moves a lot and you made very little profit because the delta was so small. Basically, this happens to many people that may have limited funds in their account and they want to trade stocks of a high price. For example, they want to trade a Priceline, they want to trade Amazon, stocks that are multiple $100 or multiple $1,000 per share, and they don't have the funds to do this properly. So what do? They load an option chain. Okay, they load an option chain, and let me load, instead of 8 strikes, I'm gonna load all strikes. And now they're like, okay, so how much money I have? Well, I would like to spend $100 on the trade. So what can I do? Oh, look, I can buy the 350. Okay, this is just moving around. I can buy the 210. Okay, the 210 will cost me $123. Okay, and now that's it. I'm good to go, right? But what's the problem? If you buy the 210, you just bought an option with a delta of 10. Okay, and by the way, let me pause here because it doesn't say 10, it says 0.10. So you need to understand that in options trading, all the figures that we see on the chain are per share. So 0.10 is per share. But we also know that in the US market, an option, call or put, represents 100 shares. So if you take that 0.10 and you multiply it times 100, it gives you 10. So in other words, you would have 10% participation in the move. Okay, and in other words, you may have this massive move on the stock where the stock moves from 169 all the way to maybe 200. That's $30 move. That's a beautiful move on the stock. And next thing you know, you are making such a little profit, okay, such a small profit. And why is that? Well, because the option you bought had a very small delta from the beginning. Okay, so you bought something so cheap that like in the real world, normally when you buy something very cheap, the quality of what you bought is very limited, and therefore probably the satisfaction you get as a customer is also limited. So in options is the same. The higher the delta, okay, so now if you go back to the 54 delta, the higher the delta right here, okay, the higher the delta, the higher the price. Okay, this option will not cost you $123 because it's 1.23 times 100. Okay, this option would cost you $1,110. Okay, so it's 10 times more price. You don't get 10 times more delta. Okay, you don't get 10 times more delta. Okay, which we need to have a conversation about this, because now next thing you know, you're gonna be like, okay, so what if I buy 10 times the 210? If I buy 10 times the 210, okay, I got 100 delta. 10 times 10 is 100 delta for more or less the same price. So what is better? To buy the 1 of the 170 or buy 10 of the 210? Okay, so what's the answer? Okay, well, and you will see the answer is going to be somewhere in between. Because the 54, certainly based on this observation, seems a little expensive, isn't it? And this one seems too cheap to be true. Okay, and you will see as we get deeper into options trading, you will also understand that. And very good question, Marcus. I'm reading your question about how is delta determined, and again, it has to do with probabilities. It's a pretty complex formula. Again, we need to go back to Mr. Black and Mr. Scholes 1985 Black-Scholes model. Okay, which by the way, that's just a theory model. Options are more complex than that. But in any case, basically the prices of those options and the calculation of its delta has to do with multiple moving pieces, has to do with what is the statistical movement of the stock, in the past. If it's a very fast moving stock, going from 170 to 210, it's going to take nothing. Now, what if the stock is a very, very boring stock? What if the stock is very, very, very boring? Going from 170 to 210 is going to take 5 years, right? So what's going to happen? If it's going to take 5 years to go to 210, well, that option for a very slow stock, that option would not have a delta of 10. That option would have a delta of, 3. And if that was to be a very fast moving stock and going from 170 to 210 is going to be way faster, then that delta would not be 10, that delta may be 25. Okay, why? Because it's a moving stock, it's a fast moving stock. Okay, so therefore everything would be different. Okay, and again, the Black-Scholes model is taking into consideration all of those different variables, such as the amount of time to expiration, the prior speed of movement for that stock, and all those things are priced in, because as you can see, there is a direct relationship between the delta and the price of the option. The higher the delta, the higher the price. The lesser the delta, the lesser the price. So if it's very likely to get to 210, that's going to be higher priced. And if it's higher priced, it's going to be higher delta. And all of these obviously would be very long to explain, and and we don't really need to understand these to trade options successfully. The only thing that you will need to understand is which delta to use, which I'm sure, and I'm hoping that you remember that normally we're shooting for deltas of around 30. Why? Because deltas of around 30 are cheaper than deltas around 50. Okay, and not only they are cheaper, they have a pretty good participation given the price. Okay, and at the same time, they don't fall into you bought something very cheap. And when you bought something very cheap, well, like in life, and options is the same. First of all, probably you're the only one buying it. No one else is buying it. So you're going to get slippage and all sorts of things. But on top of that, as the stock is moving, you will not gain any significant profit from the move, because your participation, remember delta is participation, percentage of participation, your participation, your exposure, that's another word, your exposure is very, very small. Okay, so normally we are shooting for those deltas of around 30 as shooting for that perfect, if you wish, ideal point. Okay, even though we can, because the strike price sometimes go $5 at a time, 180, 185. Sometimes it's $2.5 at a time, right? 180, 182.5. Sometimes it's $1 at a time, 180, 181, 182. So we cannot have this extremely precise delta of exactly 0.3. It does not exist. So sometimes, we need to get a little more. Sometimes we need to get a little less. Okay, so we are always flexible with the options Greeks. But coming back to what I'm saying, and coming back to the notes I had in the Word document, delta represents a percentage number. Okay, and that percentage number represents or reflects the proportion by which the options price will change given a move on the stock. I was missing an end there. Okay, given a move on the stock. So this is a form of a measurement of exposure, where in the case of stocks is normally measured in shares, or futures is measured in contracts. So for options, okay, it's the idea, and what you want to think about delta is that a positive 100 delta is the same as long 100 shares. The same thing, okay? Or negative 100 delta is the same as short 100 shares. It's the same thing, okay? It's equivalent, okay? It's equivalent. So therefore, this is going to be very, very useful for us, because knowing this equivalency, we will be able to create some hedge trades, okay, for specific trades that we may have in our account, or even produce some hedge effects for our portfolio overall. Because if you have, let's say you have 5 trades running on your portfolio, where one of your trades in the portfolio is, let's say you are long, you are equivalent long to 100, okay, so that would be positive 100 delta in your portfolio. But let's say that with another trade, you purchase puts. And let's say you purchase puts for amount of 200 delta. Okay, and then with another trade number 3, you purchase calls, and you are positive 400 delta in that other trade. Okay, so now per trade, this trade is equivalent to being long 100 shares. Okay, it's equivalent. This trade is equivalent to being short 200 shares, okay, the one where you are negative 200 delta, and this trade is equivalent to being long 400 shares. Okay, so all of these equivalencies are true, but what's very cool as well is that now you can go ahead and look at the portfolio overall, and you got 100 minus 200 plus 400. This is a net exposure for the portfolio overall, okay, of positive 300. So this is like your portfolio, okay? Your portfolio overall is that you are net long 300 deltas, not net 300 shares, okay? And let's say now you are looking at the chart of the S&P 500, okay? And you are just entering a red UFO, right? And even though you're in an uptrend, you are entering a red UFO, and this market got 52% probability of falling. Well, if the market falls and you do nothing, and your portfolio has an exposure equivalent of long 300 shares, and the market drops $2, $3, $4, you're gonna lose $2, $3, $4 times 300. Correct? So maybe you want to add some negative delta in your account to offset, okay, and hedge your account overall, okay? Or maybe you want to close this trade, okay, to be left in a net negative delta position. So you close this one, and now positive 100, negative 200, that would make you net negative 100, which is like being short 100 shares, which maybe you are happy to do that, because even though the market is in an uptrend and it's not time to short, well, you just closed a profit with 400 shares, and now you are taking a small position short. So if the market falls a little bit, it will give you the opportunity to repurchase, okay, while you made a little bit of a profit. And if it goes up, you will lose a little bit, but only a little bit, because it's only 100 delta negative. So in other words, delta is a speedometer in your car dashboard that is measuring the speed for each trade that you have running. And you can also use that particular measurement to add all the trades in an account, and therefore understand better what's going on overall in your portfolio, the account overall, okay? have way more stuff to discuss about delta. Okay, but I want to see your questions too. So guys, how is it going out there? I can see a few questions, so let me go ahead and read. Marcus, so delta is determined based on the history of the stock price and is constant different for different strikes. It's actually more complex than that, Marcus, because delta is also, that delta also has some present expectation for what the price will be in the future built in. And this has a lot to do with how options are priced. I'm not sure, Marcus, that you had the chance to review the initial videos that we did in options that are recorded on the playlist. If you haven't, I would recommend you to take a look, because there we talk about volatility, and later today I'll talk a little bit about volatility too, because volatility is priced in the options as well. So think about a call that you are about to purchase right before earnings. If you buy a call right before earnings, and normally earnings are source of gaps, because out of this fundamental change in data for the stock, many people get motivated to buy or to sell or to close trades or whatever, and the stock may gap next day. So what happens? Well, the day before earnings, there is a lot of expectation for price movement in the future next day. Okay, now it's expectation, it's not a certainty, but many people are expecting a move. So what do? They buy, right? They buy the option, the call or the put, depending if they expect the move to be up or down. But what happens? If many people buy because of their expectation, what's going to happen to the price of the option? It's going to go up. And if the price of the option goes up because everybody's buying it because of the expectation, what's going to happen to the delta? It will go up too. Why? Because we saw the higher the price, the higher the delta. It's all linked. So in other words, even though the prior life of the stock, the nature of the stock defined by its prior life, prior to today, right? How fast the stock tends to move in a normal case, how fast the stock has been moving in the past, right? So that prior life of the stock certainly sets the price of the options and therefore the delta. But the expectation for the future, which is today's expectation, because the prices of the options are refreshed real time, based on the current buy orders and sell orders that are filled in the marketplace by the market participants, correct? So that current expectation, okay, it's also that current expectation for a future movement, it's also defining delta. Okay, so again, it's quite complicated, and again, it's like we're gonna be driving cars full speed in a track, like in Austria today, if you have been watching the Formula One. And of course, do drivers understand the mechanics of an engine? Yes. Do they know everything about the engine? No. Who knows everything about the engine? The engineers. Okay, so we need to know enough about options price, but we don't need to get into all those technicalities so deep, which again, very appreciated question, Marcus, and certainly good thought. Okay, but at the same time, it will not help us to trade options efficiently, because even though it's interesting to know more about how options are priced, the key to profit with the options is to buy them at the right time and to sell them at the right time while you pick the right option. Okay, so basically to pick the right option, what I'll do is I'll give you rules based on the Greeks. I'll tell you, buy an option with a delta of 30. And if that's the rule, you don't need to know how was delta calculated or where is delta coming from. Just by knowing that you need delta of 30, you're going to be using the right option. And then if you buy and sell at the right time with the UFOs, then you'll have the nice profits. Okay. Again, your question is very good, and I always love to share insight because it certainly helps with something important too in trading, which I said many times, that starts with C. Okay, what is it that I always say that is important that starts with C? You guys answer that question while I read the next question. So Altong, when you are looking at delta of 30, is that for buying a call? What about vertical spread, bull call spread? What delta? Yes, this is for buying, okay? And this will apply to all directional strategies, okay? If delta represents a percentage number that reflects the proportion by which the options price will change, and this impacts your P&L, very good, Orlando, very good, Al, confidence, very good. So good question again, Marcus. So if delta represents the speed of profitability, let's put it this way, okay? It's a measurement that shows you the speed of profitability, okay? Speed of profitability. okay, of course, or pain, okay, because the stock may move against you, so it would be the same speed. So if delta represents the speed of profitability and you are directional, you want to be exposed with a minimum, at least with a minimum value of 30, because it would be very sad to have the stock produce this beautiful, amazing move and you only participated by 10%. Agree that the price of the option is going to be very cheap, okay, but the other question is, okay, if you only participate 10% and the price you pay was very cheap, so you make 10% of very cheap, how many options should you buy to get a proper result? And then how many commissions you're going to pay, and then how many contracts, and if you get slippage, you're going to get slippage times how many times. Okay, so you always want the delta to be an okay value. Okay, using very small deltas would be the recipe to to buy what I like to call lottery tickets. Okay, you buy a lottery ticket, it's very cheap, but what's the probability of you being very satisfied with what's going to happen to that lottery ticket? Okay, very little. So again, it's what I was commenting earlier when I said, you buy something cheap, the quality is low. You buy something more expensive, the quality is high. The key would be to find that sweet spot where you buy at the least price as possible, where you get the greatest quality as possible. And this happens to be precisely because of how options are priced. This tends to be around 30, okay? 30 something. Yeah, and a very good point as well, Orlando. The calls have positive delta and the puts negative deltas. And again, the positive or the negative, okay? In this case, remember D, okay? The D for delta tells you about the direction. So then the positive sign, okay? The positive sign, when you look at plus 100, okay? That positive sign is telling you about the direction, okay? So positive means long, okay? Or negative, okay? Negative sign tells you about the direction. So negative means short, okay? That's what that means, okay? This is what this means, okay? So the positive sign means long, the negative sign means short. That's what it is. Cool, very good, perfect. So again, delta, it's easy, okay? It's very easy because in the end, you just need to follow a rule, which is when you take a trade and you are directional, make sure delta is 30 or more. That's it. You don't want it too much more because then it becomes too expensive and it's not reasonable. So you get quality, but you pay for it too much. Below 30, it's very cheap, but you start getting low quality. So now you have this amazing move, and next thing you know, you profit too little. Okay, so we always want that delta to be 30 because it represents the speed of profitability, and being exposed to a trade where given whatever move happens, you profit less than 30. I mean, between us, maybe it's even fair to say that that means that you are not that directional. Okay, so being directional means that you are betting on a direction. So you want a decent delta. You don't want it to be too high because too high means that you pay too much. Okay, so 30 is the sweet spot. Anyway, so let's keep going. Now, there is something magic that I am about to say. And I haven't said it, by the way, but let me add one more thing before I say something magic. So up to this point, and certainly the rule with the 30 deltas applies to buying options. Okay? And if you remember what we learned in the prior sessions, buying options means that you are directional. So up to this point, everything I'm discussing applies to being directional, which is the example I gave you earlier in the Option Station Pro, which was an example where you were buying a call that is directional. Could be directional long, directional short, directional bullish, directional bearish. So you buy a call or you buy a put. But in any case, when you buy options, you get that delta exposure, and you want it to be at least positive 30 when you're long or negative 30 when you're short. Okay, that way you get a proper exposure to that direction. Okay, so again, for now I'm talking about directional trading. Of course, with options we also do non-directional trading or neutral, and then we'll have different rules, and I'll talk about that later. So right now I am focusing on the directional trading. I didn't say it, maybe I should. Okay, so let me make sure that you are with me. Okay, one sec, guys. Okay, so now here's the magic. let's do some magic, guys. So here is Alibaba. I'm just gonna go back to the one call, okay? By the way, this is how you want to do simulation for options, okay? Every time you simulate, just do everything for one unit. Get to understand your Greeks, okay? 54 means 54%. Get to understand everything you have on the screen with one, and then decide how many you want to trade, which that depends on your account size, okay? And then maybe you want 5, so you go for 5, okay? And then you click trade, and then you do the trade. Is that making sense? So again, when doing your options analysis, okay, we always do everything times 1, okay? So I'm gonna go back to the 170, analyze by, single option. Here is our single, one of the 170 call for Alibaba, expiration date 20 of September, okay? Now, on the list that I have on the top, I have the last price, okay? Let me add another one, okay? Let me add another one. And now below, I also have the last price, but what I want to do above is instead of using the last price, I'm just gonna pick a price, let's make it $2 above, that would be 171.80, okay? Or 171 is good enough. So 171 is the next price, okay? And then I'm gonna add another one, okay? And you know what, let's add a few more, okay? So I'm gonna do, so let's do below, let me add a few more. Here we go. Okay, let's do something cute. So more or less in the middle, I'm gonna have the last. Above the last, I'm gonna have 172. Above 172, I will have 175, and above 175, I'm just gonna pick randomly 180. Below the last, I'll have 168. Okay, so I'm just changing here different values for the stock, and all the way below, I'll have, let's say, 165. Okay, so what am I defining here? Here I'm defining, okay, first of all, we have the starting point. This is the current price for the stock. And now above, okay, I have placed the values in a way where they represent the price going up from 169 to 172 to 175 to 180. And then below, I have placed the values in a way where they represent the stock going down from 169 to 168 to 165. Now, remember, we also said that the Greeks that we got on the right part, they always correspond to whatever value you picked. So in this case, we picked the last, therefore 54 corresponds with the last, okay? And given the current price of the stock, we saw it earlier, we have a delta of 54, which represents 54% speed of profitability. That's what we got. Now, look at how cool this is, and that's why I called it magic. What happens as the stock moves up? As the stock moves up, my 54 delta, that represents the speed of profitability, becomes 57, which means that the speed of profitability has increased. Then my delta becomes 61, which represents that the speed of profitability has increased even more. Then it goes to 68, which means that the speed of profitability has increased even more. So in other words, the more the stock is moving my way, and this is the case because it's a call, I'm going to do the same with the puts in a minute, but the more the stock is moving my way, the more speed of profitability I gain. Remember, 54 positive delta equals 54 shares long. 57 positive delta represents 57 shares long. 61 positive delta represents 61 shares long. 68 positive delta represent 68 shares long. So this trade, okay, if you buy the call now, which is the current price is 164.80, you will pay 10.95 and now you own the call, right? And now what happens? If the stock goes up, you start making money. Why? Because it's a call. And you remember from the basic lessons that we did that the calls gain value as the stock goes up. Good. So the stock starts moving up and now you start making money. Great. At what speed? 54. Why 54? Because your position, the call you bought, is equivalent to owning 54 shares long. So you profit at a rate of 54. Right? But what happens if the stock keeps moving and moving and moving? The delta increases. And it's precisely because of Marco's question. Marcos was asking, what determines delta? And one of the things that we said is the probability, right? Also, we said the price is linked to delta. So what happens? If the price of the stock goes up and the calls derive their value from the price of the stock, and therefore the value of the call goes up, so what happens when the value gains value? Delta becomes more. We saw it multiple times earlier in the option chain. But what's the impact? And that's the magic. The impact is that the more the stock moves your way, the faster you profit. And if it keeps going, then you profit even faster. And if it keeps going even more fast, even faster. So in the world of stocks or futures or Forex, that doesn't exist. If you buy Forex or futures or stocks and it moves 10, you profit 10 times whatever your size was. If it moves 20, you profit 20 times whatever the size was. But in this case, if the stock moves to 172, you will profit the size of the move times 57%. Where if the stock moves to 180, not only the move is greater and therefore you're going to profit more, but on top of profiting more, you profit at a rate of 68% instead of 57%. Why? Because of how delta works. Okay, and how delta is calculated. People are paying more for options the higher their probabilities. If you buy the 170 strike and the stock moves up $10 to 180, the 170 option got a higher probability of producing some profit. Therefore, its price is higher. But not only higher, there is an acceleration effect on how the option would be priced for that increase in price on the stock. And that, my friends, is gamma. This is what gamma measures. Gamma measures the speed of change of delta. Where delta measures the speed of profitability, gamma measures how fast delta will change. And this, I have to say, is probably what is, I don't like to use the word confusing because it's quite simple. I'll give you an analogy in a minute and you will see how simple this is. But this is kind of like a concept that sometimes some people will give up on the Greeks. They will be like, oh, wait a minute. Now you are combining two Greeks at a time. I was kind of following the delta, but now you add the gamma. You are combining two Greeks at a time. I'm getting a little confused. Okay, I get it. This is human. When a person is being taught something new, no matter the field, and then while that thing is still new, then you combine another new thing with it. Next thing you know, you kind of feel like you need 10 minutes to think about it, right? So it's okay. I'll give you those 10 minutes. Okay, we'll take a break in just a second. Okay, and I'll give you some minutes. Okay, just a bad joke here, but I mean we'll take a break. That's serious. but in the end, the gamma is very simple. Think about it. When you drive a car, okay, you control the speed at which you travel because you have an accelerator, right? And you press that throttle, and you control the speed of the car. But there are two things that you could control the speed for. One is the speed of the car. You do it with the accelerator. But the other thing is the speed of your foot, right? So you can press the accelerator slowly or you can press the accelerator faster. If you press the accelerator faster, not only the car will gain more speed, but it will also gain more speed faster, which means more acceleration, right? So controlling the speed implies acceleration. So not sure if this is an ideal analogy or not, but hopefully it helps you. So you got two speeds to control: the speed of the vehicle, which in this case is a call, but also the speed of your foot, right? And in this case, the speed of the foot is the market, the stock. So if Alibaba moves from 169 to 172, it means that you are pushing that foot deeper into the accelerator. That will change the speed of the stock going from 54 to 57. Okay, why? Because of gamma. Okay, it's pretty cool. It's very, very cool. okay, when you have positions with options where you have positive gammas, it means that your delta will not stay static. If your delta doesn't stay static, that's when we got the magic. The magic is to profit more when the stock goes your way. But you know what? Also, the magic works in the opposite direction, to lose less when the stock moves against you. Notice when the stock goes down from 169 to 165, okay? Now, yes, of course, the more it drops, the more you lose. If it drops from 169 to 168, you lose close to $2, right? $1.8, okay? But you lose $1.8 at the rate of 51. You don't lose $1.8 at the rate of 54. You lose $1.8 at the rate of 51. And if the stock drops all the way to 165, you lose like $4.8. But you don't lose $4.8 at the rate of 54. You lose $4.8 at the rate of 46. So in other words, okay, and I will say something and we'll take a break. In other words, thanks to gamma that changes delta, right? Thanks to your foot pushing the accelerator or releasing the accelerator, right? You change the speed of the car. So thanks to gamma changing delta, with directional trades with options, you profit faster when you're right and you lose incrementally slower when you're wrong. There is no other asset that does this. And this opens a door not only to greater profits and lesser losses, which that by itself is already interesting, but this also opens the door to dynamic hedges. Okay, dynamic hedges where you can get options trades against options trades, where you neutralize or control the delta, but you still got a changing gamma that will change the delta later on. And now you can create very intelligent and efficient effects for a position or for a portfolio overall, okay? But now, my last statement probably is getting you thinking, and also I said we would take a break. So let's take a break now, and as we come back from the break, I will go ahead and explain that way better, okay? In any case, just very quick before the break, guys, could you please give me a little bit of feedback? Everybody following? Am I going too fast? Is there anything you would like me to repeat? How is it going so far, guys? Give me a little feedback, and in the meantime, I will prepare the countdown. We'll take a 5-minute break. Okay. It's going great. So far, so good. Very good, guys. Perfect. Nice. Perfect. Okay, so here we go. 5-minute break. See you in 5. Okay, everyone, this is Jose. So we are back. Could you please confirm that you hear my voice? That would be great. Sound check as we return from the break. Please confirm that you hear my voice so we can continue. Wonderful, guys. Thank you so much. Thank you very, very much. Perfect. Okay, so let's continue now. So let's get to understand a little more about delta and gamma, because if we teach this properly, really you cannot separate them. They go together, right? It's like the way I like to think about G for gamma is like G force. Okay, it's like G force. So if you are a pilot, piloting one of those amazing, planes, super fast speed planes, obviously you're exposed to the G force, and the G force is exposed when you turn. The G force is exposed when you accelerate, when you brake, when you go up, when you go down. You have the G force, right? So, and the G force impacts the speed. So that's gamma. Okay, gamma impacts the speed of profitability. In other words, the speed of profitability is not constant. And if that's the case, you want the more the better, because the beauty of gamma is that it works in both directions. So it's not like, okay, the speed of profitability, the gamma is always a greater number. Notice how the gamma values also change. Okay, not only delta is not static, delta changes because of gamma, but gamma also changes. Okay, so we will not get into it, okay? But it's like there is a second derivative of gamma that changes gamma. It's like there is the gamma of the gamma, right? And again, very complex statistical models. We don't need to get there, but at the same time, we can certainly see those changes, okay? And it's pretty cool because look, the more the stock goes against you, the bigger gamma becomes. Okay, the bigger gamma becomes. In other words, the gamma will diminish, reducing the speed of pain the more you are wrong. Okay, it's a pretty nice effect. Okay, so you would want in the perfect world, you would want the biggest gamma as possible. So let's go ahead and take a look at gamma in the so format columns in the option chain. So I'm going to add gamma so I can show you a few more things. Okay, so I'll put gamma next to delta. And now take a look at the gamma let me do this. So I'll use like 10, for example, okay? And so I want to look at first what would be the gamma in an option that expires in a week from now, okay? So you look at options that expire in a week from now, and it's gonna be 001, 002, 003, 004. What if I look at the gamma in an option that expires 720 days from now? So the gamma is basically nothing, okay? So what do you notice here? That the longer the time to expiration, the less the gamma. The less the time to expiration, the greater the gamma. Okay, the greater the gamma. So what's ideal? What's ideal would be to use the shorter expiration date as possible based on gamma. But what's the problem? I mean, if you're depending on where is your target, you may have an option expire before you get to the target because you purchase an option that expired too soon. Is that making sense? So yeah, that I get a great gamma here, with those values, whatever they are, because they are the greatest. The shorter expiration date, they will give you the greatest gamma. So whatever it is, that's what you get. So I love this gamma, it's the best. But what if your target needs 25 days or 45 days to get there? Okay, so then you could not use that one. You would need to use, any other expression date in between that will give you some gamma. It's going to be less, but it's going to be some. Okay, so again, the gamma is something that we love, and we will certainly need to pay attention to very specific values of gamma as we do specific applications when it comes to hedging. Okay, But when it comes to building the trades, okay, the Greek that will matter the most is the delta, together with selecting the right expiration date. And we have a technique on how to do that already, right? So you have learned in the prior sessions to do the TTT, okay, the TTT calculation, okay, as you probably remember. So the TTT calculation means time to target. Whoop. That's time to target. So by doing the TTT calculation and making it compatible with the earnings report date, earnings date, okay? So what we accomplish is to make sure that our options will not expire before we come we arrive to the target, while we minimize the expiration date so we get the greatest gamma exposure, okay? Also, of course, for the ones that you are experienced with options, you also know that the shorter time to expiration, the greater the theta, which has another Greek, which I'll discuss in another moment. But the theta basically tells you how much you lose per day just because time passes. And the theta is greater precisely in the shorter expiration dates. So if you use an expiration date which is short, you may lose too much per day. Okay, you may lose too much per day, which is not good. Okay, but again, by making your expiration date compatible with the one which is lining up with the earnings date, we offset that problem, number one, by having this increase in expectation in the price of the options, and the options become higher price, while you also get more gamma exposure if you can keep it short expiration date as long as it's above the TTT. Okay, so I think unless you tell me the opposite is true, I think I don't need to dive too deep into this because we already discussed that before. But I just wanted to kind of rephrase it for you to understand the logic behind it, the logic behind the instructions I give you or the rules I may give you, because again, it's important for me to share with you the why the rules are the way they are. And it has a lot to do with the confidence you need for you to trade. You don't want just to follow it just because I said it. I mean, again, it would be flattering for me if you are willing to follow what I say just because, you know, you appreciate my teaching. Okay, so that's very nice and authentically appreciated from me. But beyond that, when you find yourself on your own executing the trades from home, and it's you and your computer, no one else is there, then you need to build your confidence up. And in order to do that, you need to understand why I instruct you to do things in a certain way. So the why is important. So the why we want to keep the expiration date as short as possible, always above the time to target, but certainly the shortest as possible, is so we maximize the gamma exposure. Okay, we maximize the gamma exposure, and this way we can end up with a pretty powerful, much more powerful results. Okay, also let me add theta into the equation, even though I haven't explained theta today. Hopefully you remember from the last session. This one is the easiest to understand, right? T for time, T for theta. So as you can see, the theta in the longest expiration dates, the theta in the shorter expiration date is a greater value. So this trade, the 175 strike would lose 26 cents per day on time passing, where the 175 would lose 9 cents per day on time passing. So yeah, obviously, this one is a bigger problem. Just because time passes, you lose more. This one loses you less. And if you were to use a longer expiration date, it will lose even less, okay? But at the same time, you have less gamma exposure, okay? And at the same time, this, as you know, if this date is lining up with earnings report, you will benefit from the increase in value of the options as the earnings report approaches, which will make this value to be theoretical as 009, but in the real world, this value may become of a much lesser value, similar to what you get in further expiration dates, because you are going to capture some inflation kicking in the price of those options. So this is not too important, and by keeping the date not too far out, you are now collecting, again, a greater value of gamma. This is why we use the TTT, and then we make it compatible with the earnings date, okay? So hopefully this is clear. I would love to see some confirmation on the comments box, guys. If you could just click just one word, all clear, or if you have any question, this would be the time to ask, okay? So now, coming back to what we're doing, so the gamma goes together with the delta. You cannot separate gamma and delta, okay? Gamma is the speed at which delta changes. So what does that mean? Okay, well, using my prior analogy, is the speed at which you step on that accelerator, okay, how hard you step, okay, that's your gamma, okay. So this obviously impacts, okay, so this measures the impact to the speed of change of your P&L, which, coming back to what I used before, speed of profitability, okay? So this is the change of speed of profitability, okay? So hopefully all of this is clear, okay? Now, what's key, okay, and this is where gamma becomes amazingly useful, is that we also said that delta is an equivalency that tells you more about your equivalent position size. We said that 100 delta positive, it's equivalent to being long 100 shares, okay? So if this changes the speed of change of your P&L, if this impacts the speed of change of your P&L, and that was equivalent to the position size, so this is this impact, gamma will impact, okay, impact the size of your positions, okay? Dynamically changes the size of your positions. A position started with a size of 54 and then it became 61. Why is that? Because gamma impacted the size of the position, is the G-force, okay? Gamma is the G-force. So yeah, so again, powerful stuff, because now that we understand a little better what is gamma and what is delta, I want to get into the applications, okay? Because starting from now on, when we do get together for longer term, up to this point, I've been giving you detailed instructions on how to enter your trades. True is that I also give you targets, okay? And what you're supposed to do when you get to the target is just to close the trade, that's it. But the reality is that you could do things that are way more intelligent, because you can set up dynamic hedges thanks to the positive gamma values and do stuff that is very, very, very interesting. Okay, so let's go ahead and let me give you an example so you understand much better what that means. Okay, so I'm gonna use some space here, and I'm gonna do some drawing on the screen, on the charts, and try to visually explain something that is very, very powerful. Okay, so guys, here is a chart. So let me see, 55-minute time frame of the S&P. Here we go. So we got the 55-minute time frame of the S&P. So let's say, what was that? 627, 628, and this would be 626. So let me see if I can come up, by changing the days, come up with a nice setup on the screen. Okay, so 626, let me try 26. So let's see what we got on the 26th of June. Maybe 27. Okay, so 27. Not 27. And what about if I use, I'm just trying to get a nice setup on the screen so it becomes easy to understand for what I want to explain. And by the way, I'm using pre and post market, which is much better for the S&P ETF than regular trading hours. Okay, so let me go back to 26. Okay, I'm gonna say it's good enough. So let's say, okay, let's say on the 26th, okay, you decided to enter a trade, and to keep it very simple now, when talking about entering a trade, I'll talk about buying a call. Okay, so let's say that day, even though it didn't come exactly inside the green, okay, let's pretend out of simplicity that it did touch the green, which probably it did in the futures, but not on the ETF. And let's say that day you bought a call. Okay, so that day you bought a call, and now two things may happen. That market may go up, that market may go down. So what you would do, as always, you would set your entry, which is the day where you bought the call. You would also set your target. Okay, let's say the target it's much higher, all the way there. Let's say around $300 per share for the S&P. Okay, let's say that was your trade, and you purchase a call. So if you purchase a call that day, what do you end up? Well, if you buy a call, okay, you end up with positive delta, okay, which I'm gonna make up. Okay, we could certainly use analytic tools and go back in time, but if that's okay, out of simplicity, I'm just gonna make it up. Let's say your delta was positive 35. So let's say you bought a delta positive 35. So you bought, I don't know, maybe it was the 291 call, something like that, and you got a delta of 35. Okay, with X amount of days to expiration, whatever that is. And let's say that option also got a gamma, which is also positive. Okay, and let's say the gamma was +1, okay, or +1.5 or whatever. So let's say that was your trade. From there, two things may happen, which is the stock go up or the stock goes down. So let's begin with, what if the stock goes down? Well, if the stock goes down is a problem. Okay, and in a basic way to trade, you will want to use stops. We also talked about many times the fact that stocks are a fragile instrument because they depend on the indexes, and it is often more intelligent not to use stops with the stocks, especially because we know that when you buy a call or when you buy a call spread or a spread in general, the most you can lose is what you pay for it. So since the most you can lose is what you pay for it, you have the risk under control, and therefore it may be okay to leave the trade alone, because if that green UFO doesn't work, okay, the one where price is right now, if that one doesn't work, price may have to fall until it gets to 285, and those UFOs will turn the price around, and then later in time you get to 300. So if you had set a stop right below this UFO, it would not be incorrect, but it could put you in a situation where you get stopped out and then you miss reaching the target. Good news is that you would have lost very little, but the bad news is that you were out of the trade, where the fact is that in the end you were right on the you were right on the direction, you were just a little off timing, and this happens very often with stocks because stocks are depending on their sectors, stocks are depending on competition companies. For example, Apple stock may depend on Microsoft stock, all of them depend on the index. We talked about that before, right? So a very intelligent way to approach it is that maybe, you know what, I'm just gonna not use stops, set my entry and set my target, and those are the only two parameters that I will want to set: my entry and my target. That's it. That's all I will set. And if I'm right, congratulations. And if I'm wrong, the most I will lose is what I pay for the call. And this will be a very valid way on how to plan those trades. But at the same time, there may be times where it's a little too hopeful to just keep allowing the stock to go against you and more and more and more, because it may never come back. Because maybe the reason why the stock didn't react well to those on-field orders is because the on-field orders were canceled. And when are the on-field orders canceled? Well, they are normally canceled to be replaced by sell on-field orders. And when that's the case, probably is because a new downtrend may develop. So if that stock now develops a new downtrend, it may never come back. And then, yes, you had the risk under control, because the most you can lose is what you pay for the call. But at the same time, there was a moment in time where it did not make sense to stay on the trade, and you did stay on the trade, kind of guaranteeing that you lost the whole premium paid for the call you bought. Okay, so maybe a different way to approach it would be, okay, let's say I buy here, and if the stock goes against me, I'll stay in it because I got more UFOs below. And I expect the stock to bounce from those UFOs. Okay, I expect a bounce. I expect a bounce. But if the bounce doesn't happen, and that stock keeps going down, okay, then now I got 3 UFOs that fell. Well, I should do something about it. Okay, and this is when we will need to talk about damage control mode and stuff like that. Okay, and we'll talk about how to create a trade that potentially could bring you some profit back, given the fact that your initial trade is clearly wrong. Okay, so we'll talk about damage control. Okay, and you'll see how gamma is very interesting. Okay, I will not be able to talk about damage control today because that implies I first need to talk about advanced option strategies beyond buying a call or buying a spread. Okay, buying a call or buying a spread implies 1 or 2 options at the time. Okay, so getting into damage control mode. Okay, damage control mode will imply, 4 options at a time. This is what is known in the options world as complex strategies, which complex doesn't mean complicated, but they are more complex in the sense that there are more legs. So I'll need to talk about that first, and then I'll have to come back to this conversation and talk about what can you do when a stock just keeps going against you all the way and keeps going against you all the way and keeps going against you all the way. So we cannot just hope, even though it was okay because you had the risk management under control from the beginning. Again, the most you can lose is what you pay for the call, but at the same time, we'll be able to do things that are more intelligent. Okay. So what I could talk about today, which is a direct gamma application, is what if the trade worked well. So let's say that day, let me draw this again. Let's say that day you bought the call. So again, that's your entry. Okay. And let's say that you have an exit, as we said, at 300. That's your target. Okay. And the stock starts bouncing. Okay. Now it starts moving your way. Okay. But now, even though your target is 300, you see a red UFO in front of you. Is this a concern? Well, not really, because the reason why you got into this trade in the first place, as you can see on the left, right, is because the trend was up and the DMI was green. So in an uptrend, you may remember I said many times, sell on field orders tend to be canceled. So even though we do have sell on field orders, they will likely tend to be canceled, and therefore price will be able to continue. But at the same time, what if that's not the case? What if they are not canceled? Well, these may bring the stock down big time. So one thing that you could do, okay, and we'll put rules around that, but one thing that you could do is as the stock keeps going higher and reaches this red UFO and is likely to continue all the way to 300, but may not continue, well, this could be a fantastic time. This is actually the time to set a dynamic hedge using the gamma. Okay, so we're gonna set up a gamma hedge at this point. Okay, so what is a gamma hedge? Well, this is something new. Okay, guys, so pay attention carefully. And let me know if I go too fast or you need any additional explanation. Okay, so again, let's pretend when you got into this trade, you got a positive 35 delta. And of course, you also got positive gamma. Could be +1, +2, plus whatever. But again, we cannot control that because the gamma is controlled based on the time to expiration, which is controlled based on the time to target. So in the end, wherever gamma you get is what you get, right? So let's say it's +1, +2, +5, whatever you get. So for sure, what that gamma will do is to change delta. And as the stock keeps going higher, it will increase your delta, right? So at this moment in time, when the stock reaches the red UFO, your delta is not going to be +45 anymore. Now it may be plus 55 delta. Okay, so that's a good news, because what's happening at this moment in time is that you are profiting faster. So if you purchased at, let's call it 290, and the red UFO, let's call it 293, so you just made $3, and you made $3, you made 35% of $3. That would be based on the initial delta. But good news, that's the magical news. Instead of making 35% of $3, you made 55% of $3, right? That's the magical news. This is how options accelerate the speed of profitability. We talked about all of this. So all of this is great, but it's not over yet. Okay, this is not over yet. In other words, if the stock keeps rallying up to all the way to 300, when it gets to 300, your delta may be of plus 75. Okay, that may be your delta at that time. Okay, so the delta will keep increasing. And by the way, if the stock now reacts to the red UFO and was to fall, okay, so if the stock was to fall, the 35 delta will go back to become 35 delta. Isn't it? Because remember, gamma changes delta when it goes up and when it goes down. So in other words, you not only you made a profit at that point, you also increased your position dynamically. Your position was equivalent to 35 shares. Your position became equivalent to 55 shares. Your position is about to become 75 shares if you get to the final target. So what would be a shame is that not only you are right on the direction, but on top of that, you increased your position size and your participation, your exposure from 35 to 55. What would be a shame is that now this red UFO brings the price down, and not only now you give up the profits you made, but on top of that, your position goes back from 55 to 35. That would be very sad. Okay? So what can you do? Well, imagine for a minute. Okay, and I'll give you version 1 first, so it's easier to understand, and then I'll give you version 2. So imagine for a minute that when the SPY reaches 293, you go ahead and you short 100 shares. Sorry, not 100, 55 shares. If I short 55 shares at this moment in time, what's this gonna do to my delta? Well, it's gonna make my delta to be 0. Okay? Why? Because we said that a short position with 55 shares is equivalent to a negative 55 delta. So if you are long a call that produces plus 55 delta, okay, that's your call. And now you just add, using shares of stock, you add a short trade with 55 shares, you are basically creating a delta neutral position. And you may be, okay, so why would I do that? This is a waste of time. Now if the stock goes up or the stock goes down, I make nothing because I got 0 exposure, right? Well, yeah, you are right at that time. But what if the stock keeps going higher or lower? If the stock keeps going higher, the minus 55 delta will remain minus 55 delta. But the 55 delta from the call will become 75. So if the stock goes higher, okay, if the stock goes higher, okay, and reaches the target, okay, so let me find it, higher, we would have the negative 55 delta from the short position, but we would also have a positive 75 delta position from the call. So basically, you would be netting plus 20 delta. So it's like, this would be equivalent to closing the trade at 293, but stay in a position size of additional magic 20 shares that were added to you for free in the market. And when the market went from 293 to 300, you made $7 with 20 shares, right? And what if the market was to fall? Well, if the market was to fall from 55 to 35, so what's going to happen? here. So if it was to go lower, okay, if the market was to go lower, you will still be short 55 deltas with the short position, okay? And your 55 delta with the call will become 35, right? So 35 delta positive minus 55 delta negative, this is net minus 20. In other words, this is like you are net 20 shares short. So if the stock was to drop from 293 back to the entry that was 290, even though the stock moved against you by $3, not only you didn't give up the profits back, but you actually made $3 on an equivalent size of 20 shares short. So the moment you got to the dynamic hedging place on the chart, you entered a gamma hedge, and if the stock goes up, you profit. If the stock goes down, you profit as well. So you did create at the beginning a position with no exposure. The position became 0 delta, so there was no exposure. But because gamma is out there and gamma changes delta, this produced an effect where if the stock went up or the stock went down, whatever happened out of that red UFO, whatever happened, this produced a delta exposure that benefited you no matter what. So this is a very, very powerful way to think about your exposures, to think about your hedges. I have to add much more to this, okay? But before I keep going, how is it going so far, guys? Is anyone confused? Did I lose anyone? Is everybody following? How is it going? Wow moment, great, oof, very good. Perfect, okay, I like it. Even your oof, Orlando, which may represent that I went a little too fast, a little too deep. I know your oof means you're excited. So let me rephrase this, okay? Let me rephrase this and let me keep going so you will see how this is gonna do. This is gonna be, okay? Very good question as well, Al. Asking, can you buy a minus delta put and accomplish the same? So we need to talk about that. Still quite some things to learn. I get you, Marcus. So let me erase everything on my screen, start again, because in this second pass, this is gonna go better, okay? So first of all, we need to differentiate two different cases, okay? Which is when you're right and when you're wrong, okay? So this is the time when the trade is being entered, okay? From there, it may go up, it may go down. Let's say it goes down, so then we need to do damage control. We need to learn that in other sessions, okay? Let's say it goes well, and now it's moving your way. So as the stock is moving your way, there will be threats along the way. Markets don't go up straight in a straight line and never come back. Markets will correct. Sometimes the correction may be too much. Sometimes within the correction, new UFOs are born, isn't it? And it may be time to get out, and you may never reach your target. So things happen during the life of a trade, isn't it? And you could certainly be totally passive about it and do nothing at all. You could certainly approach it this way. And I would say it's not too wrong, but at the same time, it's a little too hopeful. We talked about that before. Okay? Markets change dynamically. To be in a trade where you plan to be there for 20 days, 10 days, or 3 hours, and expect that everything's going to be okay because 3 hours ago you planned the trade the way you did, maybe a little too hopeful. New on-field orders are added and canceled in the marketplace all the time. Okay, so we talked about the other day, we talked about this book approach of setting targets at 3-to-1 just because you want it to be 3-to-1, and let's go for 3-to-1 just because I like 3-to-1. It's just a little too hopeful. We need to react to the reality of the market, which is dynamic and keeps changing, isn't it? So the more dynamic stuff that we can do in our trades, the better the results. And Gamma, as you can see today, Gamma is totally dynamic because Gamma will change your delta depending if the market is moving your way or going against you. So Gamma itself is already adding a dynamic result in your trades. This is already beautiful by definition. But now we're going to combine it with a hedge concept to make it even better. Okay, so think about this. Okay, so forget about options for a minute. Marcus, I read you, my friend. No worries. You're going to be okay. Just bear with me. You're going to be okay. And I'll come back to your question and everything. And by the way, I know you are in the process of, watching some of the prior option sessions, okay? So anyway, bear with me. You'll see. So forget about options for a minute, as I was saying. Let's pretend this is a regular futures trade like what we do on the Tuesdays. What do we normally do? Don't we always set, let me use this one. Don't we always set a final target and somewhere below we have a safety target and then we have the entry and then the stop, right? So what do we do with the safety target? Don't we set the safety target a 1-to-1 mechanically so we remove the risk of the trade very quickly, and that way whatever happens happens. If we end up getting to the final target, congratulations. If we end up being stopped out, not a big deal, because we already took half of the position out with the final with the safety target. So why do we do this? We do this because of the dynamic nature of the market, where things happen and anything could happen anytime. So by removing the risk of the trade as soon as possible, next thing you know, now you are left in a position where you don't care what's going to happen, because whatever happens is not going to hurt you. If any, it's going to be joy. So that's why we do it. Okay, but what's the problem of doing that? Okay, even though we love doing this, and definitely it's efficient, and that's why we do it. The problem with that is that now when you get to your final target, what are you left with? 50% of the size, because the other 50% was removed here, right? And in futures and stocks and Forex, there is no gamma. If you close 50% of the position at your safety target, when you get to the final target, you are left with the other half. So that's it. So in other words, that is very useful to be done, but the impact of removing half of the position at the safety target is what it is. The impact is that you will be left with half of the position at the final target. Now, what if I was to do something like that with gamma? So if I was to do something like that with options, so now we are adding options. Okay, so if we add options to the equation, okay, we have a final target. Okay, we do have a final target. You may also want to define a safety target or a thread UFO, okay, or a thread news, okay, anything that could be a thread, okay, and then you have your entry, and then we have no stop. So what can we do? Well, get into the trade at the entry, okay. To keep it simple, I'll say buy the call. So plus C, plus call. So you buy the call. It could be a call spread. Okay, so you could buy a call and sell a call together at the same time. Which that's what we do, right? That's what we do all the time. But to keep it simple now, I'll say you buy the call. So you buy the call, and now what? Two things may happen. It goes your way or it goes against you. So if it goes against you, okay, bad news. Okay, now the good news within the bad news is that the most you can lose is what you pay for the call. We said that already. The other good news within the bad news is that we'll learn to do damage control. Now, damage control is not going to fix the world, but it will make your losses to be way smaller and sometimes convert losses into profits. So we will appreciate damage control mode, okay? But it's still a good news within the bad news, okay? So it's not the best. The best is when it moves your way, okay? So that's the best. Now the stock is moving your way, okay? So now you're happy, but while you're happy, you may hit threats and it may go back against you, okay? So what could you do? Well, you could close calls. So let's say you bought 5 calls or 10 calls. Maybe you could call half. If you close half, great. You collected some profit. If the market was to go back against you, since you already collected some profit, so now similar situation as futures. Now you would not lose anymore, or what would happen is that you would really minimize the loss. So same as futures or Forex, you could certainly do that. But what's the problem? The problem is that now when you get to the final target, you would be left with half of the position. We don't like that, okay? So what can you do? Well, when you get to this situation of a threat or a safety target, Oh, I'm just realizing I type SF instead of ST. Sorry for that. Safety target, that's what I meant, okay? So when you get to the safety target, so what you could do is enter a dynamic hedge. A dynamic hedge is a gamma hedge, okay? Use the G-force, okay? How can you use the G-force? Well, if you bought a call and this call provided you with, let's say positive 35 delta, okay? You can go ahead, okay? And you have two choices. Look at what the new delta is when you get to your thread, okay? Which the new delta, let's say, is plus 50. So then, option number one, when you do your dynamic hedge, do minus 50. Minus 50 means short 50 shares. Now, I need to give you an alternative for shorting shares, because shorting shares is expensive. I know some of you are thinking about it. I need a lot of money to short shares, okay? Unless you use a portfolio margin account, where now it's very easy to be done. But if not, shorting shares will be probably way too expensive. So I'll need to give you an alternative, okay? And Al had a good idea earlier by buying a put, but I need to give you more instructions on which put and stuff, okay? So we'll talk about that. For now, let's talk about shorting 50 shares. So you have 50 delta from the call, you short 50 shares, you are in a delta position, and in a neutral delta position, and what happens? Well, now when you get to your target, okay, you're gonna get a profit which is diminished by the 50 shares that you shorted. But because you got positive gamma, when you get to the target, you don't get 50 delta, you get positive 80 delta. Now, positive 80 delta minus 50 will give you a net 30. Okay? Minus 50 will give you a net positive 30. Okay? But positive 30 is going to be way more than if you closed half of the delta, half of the calls. Because if you close half of the calls, you would have been left with 25. Is that making sense? So you will get there with 25 instead of 30. And I'm rounding numbers here and improvising a little bit the figures just so you understand the concept, okay, guys? But what's the other beauty? The other beauty is that if you never got to your target and that stock fell, okay, or even fell even more and more and more, let's go crazy, okay? It went all the way to zero. Well, if it went to zero, okay, if you went to zero, what happened? You were still short 50 shares. So you made a lot of money with the 50 shares that you were short and having the stock go to zero, okay? And of course, the call became zero delta. So in the end, you collected, oh, I just erased everything. That was not ideal. Okay. I'm gonna have to retype stuff here, but anyway, hopefully you saw it, okay? So basically, if the stock was to go against you, you would profit, and if the stock was to move up, you would profit as well. That's the dynamic hedge that I'm talking about, okay? That's the dynamic hedge that I'm talking about, okay? Now, there are different ways to think about this, okay? And I would like, simple works. So I'm gonna show you a simple approach on how to do this. Yes, G-force is very useful. You're right. Let me read your questions before I keep going, guys, because maybe I'm going too fast. So, yep. Yes, Marcus, I'm lost, but I like it. Need to start with the basic of options. For me, it's like having a look into my future. I like strategy and stuff. Yes, absolutely. Yeah, take care, Marcus. Yeah. G-force, very useful, absolutely. So guys, again, if there is any question at this point, you need to type it, okay, guys? We are approaching the top of the hour, which we should conclude the session soon, okay? So we may surpass the top of the hour for a few minutes, but we'll conclude the session soon, okay? And we will be applying these starting next Thursday, okay? So we're gonna do that, okay? And with credit is a different story because this is for directional trades, Orlando, okay? This is for directional trades. So credit is going to be a different story, which we will need to address separately. Remember what I said at the beginning. So again, let's say you are planning on a trade with a specific stock. Okay, and you have your final target. You have your final target. You have, I'm gonna call it threat, somewhere in the middle, and then you have the entry. Okay, so what will you do? The first thing that you will need to look at is what is the delta at entry? What is the delta at entry? Okay, the delta at entry will be seen in the option chain. Okay, we'll look at an example when I'm done with the explanation. Let's say your delta is 35 delta, positive. Okay, so now you know what's your delta. So again, if the stock goes against you, that's damage control. We'll talk about it another day. But what if it goes your way and it hits a threat? Then you want to implement a dynamic hedge. The dynamic hedge will be done by entering, okay, you need to enter negative deltas. How can you enter negative deltas? Short shares or buy put. Okay? Short shares or buy puts. Buying puts will be negative deltas, just like buying calls is positive deltas. Buying puts will be negative deltas. The easy way to think about it is shorting shares. Shorting shares is also negative delta. Okay, but again, buying the put will be way cheaper. Okay, so we will buy puts. Okay, unless you have a portfolio margin account where you can go ahead and short shares because the margin implications are very low. Okay, so if I enter negative deltas at that point, I am neutralizing my position in ways where if the stock was to go back down, I start making money on the negative deltas. Okay, I start losing money on the positive deltas, but I start making money on the negative deltas. So if the stock goes back to the beginning, the initial profit I made is locked. Okay, it's like I exited the trade at this point, the initial profit is locked. If the stock was to continue falling beyond my entry, okay, I actually make more money. Okay, because now my negative delta has increased more than the positive delta. So now, you know, my positive delta becomes plus 30, plus 25, plus 20, where my negative delta remains as, let's say, minus 35. So my negative delta remains as minus 35, minus 35, minus 35. So what happens? Well, you are now netting in here, you are netting minus 5, so it's like you are short 5 shares, minus 10, you are short 10 shares, minus 15, you are short 15 shares. So the more it falls, the more you profit. Is that making sense? So you would want to add negative deltas when you get to where the threat is. So that way, if the stock moves against you, you start making money. And if the stock goes your way towards the final target, you start making money too. Why? Because your positive 35 becomes positive 55, becomes positive 60, right? While the negative deltas remain as minus 35, remain as minus 35, correct? So what's happening? So you are netting, at this point, you will be netting plus 25, if I'm not mistaken, right? So you are making money, you are making additional money if it goes up, you are making additional money if it goes down. So you have this dynamic hedge. It's not like you paralyze the trade when you have the threat, and now, you know, if it goes up or down, you are hedged. Hedge means you paralyze the trade. Here, the hedge is dynamic because of gamma, okay? So loving the G-force. Now, the key is how many negative deltas to use when you do the hedge, okay? And do you do it by shorting shares or buying a put? And if you do it by buying a put, which one do you buy? Okay. So guys, the way to do this, okay, let me go ahead and do this with a proper example now that you got the explanation, if you wish, with all this writing I've done on the screen. So let's go ahead and use real-time data on the screen, and let's look for some stock. Okay, I'm just gonna quickly run the scanner for directional long. Okay, we'll look for some stock and hopefully we can find something quickly, and we'll put an example together, and then I will give you instructions for how the hedge would be done. And hopefully this would conclude the session for today with a full understanding from your side, and then we will start building experience on how to do this as we are running sessions together on the Thursdays when we do get together for longer term, okay? So just gonna wait here for the scan to complete. Yep. What do we have here? Yeah, so again, Orlando, we will not look at the credit, okay? As I said, we'll talk about that in future sessions as well. But the reason why we're not gonna talk about it today, it's actually, the reason is fundamental, okay? So if buying a call or buying a put has positive 54 delta, what happens when you sell it? Well, when you sell the positive, it's negative. So selling calls have negative deltas. But what about the gamma? If the gamma is positive when you buy it, what about when you sell it? So if you sell the call, you have negative gamma. And same for the put. Okay? The put also have positive gammas. So if you sell the put, you got negative gammas. In other words, selling options always produce negative gammas, where buying options always produces positive gammas. So today I call positive gammas the G-force. Today I call positive gammas the magic. So what happens when you sell options? You have the inverse of the magic. Okay? You have the magic working against you instead of for you. You cannot hedge negative gamma positions. Okay? So, and by the way, when you do credit spreads, you don't have a target either. You don't care where the stock is going. The only thing you want, Orlando, is you want time to pass so the option expires. You simply want the stock not to reach a certain point. Okay, so we don't have a need for hedge either. So what we will need to learn with the credit strategies is that we will need to learn the damage control mode. But there is not a real need for hedge, because there is no directional need with the neutral or non-directional strategies, which are the credit ones, okay? Okay, guys, so we have our scanner almost complete here. I see a few more questions coming in. So Alton, any studies that show profitability closing the trade at the thread versus using the dynamic gamma hedge? Yes, certainly. Trading trading. A good trading methodology is finding a good balance between the probability of catching a turning point together with the probability of reaching a target. Right? So if you catch turning points all the time, but you never reach targets, then you better take profits sooner. Okay, so if you were to take profits whenever you have the hedge, you will likely increase the probability of profits. But at the same time, if those profits are not significant enough, then you may have 3-4 losses in a row, and next thing you know, your account is in real pain. So you always want to attempt maximizing the profits, and doing the dynamic hedge is fantastic because you basically accomplish locking in the profit when the thread is, but then if the trade keeps working either up or down, you add extra profitability on top of what the profit would have been if you had closed the trade where the thread was. Is that making sense? So in other words, with other markets that are not options, it could certainly make sense to close the trade where the thread is, but with options, because you have gamma, in the case of directional trades where you are a buyer of options, buying calls or buying puts, so now you can go ahead and enter a dynamic hedge and enhance the profit that you would have taken when the thread showed up. Enhance that profit no matter if the stock is moving up or down at that time. Okay, so very powerful stuff. Okay, and I guess that you are thinking about it intensively at this point. Okay, your question is very good, and hopefully my answer is really adding light to it. Okay, John, am I correct in saying that when the hedge is applied, that the only way we do not make money is if price stays at the hedge price? Yeah, well, when the hedge is applied, you apply the hedge after a move, so you have already collected, you have already created a profit, and the hedge guarantees the profit to remain as yours. Now, having said that, you have a point, which is if time keeps passing and the stock is not moving, yes, is it that the hedge locks in the profit, but yes, is it that the call you bought is also losing value based on time decay. So if the price of the stock was to remain in the same place for too long, that would not be good, because you would start seeing your profit to begin being slightly eroded by time passing. And that's not ideal. Okay, so we'll need to add rules on how long you're gonna give yourself to do that. Okay, and basically we will use a combination of looking at gamma and ATR to come up with a rule. Okay, we will learn that. Okay, give me a second, guys. Good, perfect. Okay, so yeah, theta damage. Very good. So we got the results. Okay, so let's take a look at, let me see what we got here. So I'll look at, yeah, let's take a look at Adobe, for example. So we load Adobe, I'll get my option chain as well. So the option chain is loading with Adobe. Okay, so let's see if we're gonna have an opportunity with Adobe. So 45, and we got 48. Okay, so that's not really good enough. So we're gonna look at Amazon. And 46%. If I activate US and pre-market, 46 becomes 53, but we have no green UFOs anywhere close by. So Amazon, no good. What about Facebook? Let's see if we can find a trade that's actually a good one. So not only we can use it for the example, but we can also use it in the market. So Facebook looking good, strong. We got 56% with US pre and post market. Regular session provides us with 48. So obviously with Facebook it's better to use pre and post. And we got this moving average at 188. So at 188, we got no green UFO, but we have this UFO right here. And by the way, when the market opens tomorrow, given the fact that the close was above the average, this average will push up a little bit, and instead of 188, it's probably on the 189s. So I'm gonna say this is gonna be good enough to plan on a trade. Okay, so let's say I'm gonna enter this trade with Facebook, leaning against our beautiful green UFO as a source of unfilled orders to buy, pushing Facebook back up. So what we would do is step one, identify the entry, which is that green UFO. Step two, we would look at the target in a weekly time frame, since the trend and the market condition is strong. So in a weekly time frame, activate UFOs, and the red UFO we have is located at 218.62. Okay, so 218.62. So final target 218.62 for Facebook. Okay, color purple. Okay, that would be the final target. Good, perfect. So disable UFOs in the weekly time frame. Okay, go back to the daily time frame. Okay, and we are ready to set the trade. Okay, so if I was to set this trade with Facebook, the first thing I need to calculate is my time to target. So time to target would be done by using a calculator. So now I'm just using the same process I would use in any Thursday session, isn't it? So 218.62 minus the beginning part of that UFO, which is the entry. The top part is 191.15. So 191.15, that is going to be the entry. Okay, so entry time, final target 191.15. So 218.62 minus 191.15, that happens to be $27.47 of room for profit, average to range, happens to be 4.49 for Facebook. So this divided by 4.49 give us 6 weeks to get to the target because of our assumption daily ATR equals 4.49. Therefore TTT is going to be 27.47 divided by 4.49, that is going to be 6.11, and this is per week. This is 6 weeks, so times 7, that is going to be 42, let's call it 43 days. Okay, so this is what we get, and this is nothing new. If you are a little undecided on how I came up with this number, it means that you are missing some prior sessions. So please make sure you watch those recorded sessions. That's our TTT. Okay, now before we conclude, 43 is going to be the right number. We also need to look at the earnings report for Facebook. Okay, and the report for Facebook will happen on 1, 2, 3. Come on. Why is it not? Maybe I didn't click search. Okay, no. So it's going to be July 24. Okay, so I need to keep in mind this date of July 24. So TTT 43 earnings date is July 24. So now what I want to do is load the option chain with Facebook and focus on that July 24, which in this case is going to be July 26. We have a little problem, which is not a big one, but the fact is that that expiration date expires on 27 days from now. Okay, 27 days from now, which is not, okay, 27 days from now, it's not the 43 days we need to get to the target. So in other words, this is looking like a trade where we will not be able to achieve the target, and therefore our target will be either set based on the date or set based on the price. So if Facebook was to start moving at the speed of the light to the upside, we may reach 218.62. If not, okay, if not, we will need to be out. Okay, so final target will be based on price or based on date in this case, and the date would be July 19. July 23 or 24, depending on the earnings are being reported on aftermarket. Okay, aftermarket. So we can get out of this trade on the 24 during market hours because the report is after. Sometimes the report is before market. So then we're gonna use July, not 23, but July 24. Okay, July 24. This is important stuff to keep in mind. Okay, so anyway, so this is the trade. Okay, so expiration date will be the one. Expiration date will be July 26, 2019. Okay, which is the one where the earnings report will take place, and this will bring the value of the options up. Okay, so this is the one that we're gonna use. So when it comes to putting the trade together, of course, since the final target is 218, so we're gonna look at the 218. I need to load more strikes. So 218 would be to 17.5. Okay, so what I'm gonna do is instead of buying a call, okay, Instead of analyze, buy a call, I'll make it a little more close to what we do on Thursdays, which is we do bull call spread. So I'll do a vertical. Okay, I'll do a vertical, and this vertical will be made of here we go. We're gonna be selling the 220 or okay 217.5, which is close to 218, and then we will be buying an option to produce a delta of at least 30, okay, when we have the last. Remember, we want a 30 delta participation, okay? So this will bring my option to 197.5, I would guess, yes. So 197.5, which is just a little higher than the current price. So we'll do 197.5 to 17.5. This would be the combination to be done, okay? So 217.5, okay? So we're gonna be buying and selling. So sell 217.5 call, and then we're gonna be buying by the 197.5 call using July 26, 2019 expiration date. Okay, so this is a trade which looks valid to be executed. You just need to wait. Hopefully on Monday, Facebook falling down from 193 to 191.15, as you can see here on the left part of the screen. Okay, so this what I've just done up to this point is exactly the same that I would do in a Thursday session, planning the trade, even though hopefully now you have a little bit of an understanding of why I adjusted delta the way I did. Okay, now the question now is, once this Facebook stock comes to the entry, okay, once the Facebook stock comes to the entry, let me move this away. So from there, okay, when it comes to the entry, you get filled on your spread, and now it may start moving higher. So as it starts moving higher, it may hit this red UFO, or maybe a new red UFO is formed, right? So you may have something like that happen. Let me push this down. So it comes to the green UFO, and now it starts moving, and the moment it starts moving, now a new UFO forms, price goes down, right? And now you have a new red UFO that was not there before, that now is here, okay? So now when Facebook comes back here, so guess what? This is time to hedge, okay? But you want the hedge to be dynamic. So this small profit that you just collected, you want it to enhance if it keeps going higher, but you want to add more profits if the market goes back down, okay? Because this red UFO may be the source for concern. This is what I've been calling a threat. So what would you want to do? Well, you will want to keep in mind the initial delta, okay, that you got in the trade. If you keep in mind the initial delta that you got in the trade, this would be this particular figure, 33. Okay, that would be the particular figure that you would need to keep in mind. So one option would be for you to go ahead, and when you get to the threat point, you could go ahead and hedge. You could go ahead and hedge with the same amount of deltas that you've got at the beginning of the trade, okay, which was 33, okay? So that's one way to do it, okay? But this is not my favorite way to do it, because then if the stock goes against you, you basically break even, but you don't make a profit if the stock goes against you, okay? And in order to create, if you were to trade only one position at a time, I would say it's okay. And this is what you normally do intraday, and that's why we do the one-to-ones and all of this. But when you do this with a portfolio where you're running multiple trades at the same time, normally in a portfolio, the key goal is to create more stability. If you only trade one futures markets at a time for intraday trading, you know some trades profit, some trades loss, and therefore the result of the portfolio, the result of your account will go up and then will go down, and you may even have losing days. You may even have losing weeks, and it's okay because the next week you trade and you make money and it's all good. But when you work with a portfolio overall, normally you want to create more stability. So I like to be able to make money in both directions. Therefore, the type of hedge we want to do is a little more aggressive than simply using the initial shares you got at the beginning. Which, by the way, I'm realizing I made a mistake with adjusting this trade. Let me rectify that, because here I never changed this to 191.15, which is the entry point. So 191.15 is the entry point. This is giving you a delta of 30, so it's still good. So again, remember the delta you want is from 30 to 30 something. So we got 30 is perfect, okay? But I forgot to change that, so I need to say it so you don't forget yourself, okay? So how can you reevaluate that, okay? So what you will want to do is that whenever in the market something has happened, so for example, this thing went down, you got filled, now it's moving your way, now a new UFO forms, okay, and goes down. So you now identify the threat. So you look at the price, and to keep it simple, let's say that's 195. So if this is 195, when this comes up, you want to hedge. So the question is, what are your deltas at 195? That's the question. So quickly, you will want to come to the simulator, okay, and change this to 195. Okay, you change this to 195, and you will now see your delta is 35. So if your new delta is 35, that is the value you want to use. Notice that the initial value for deltas would be expected to be plus 30. Okay? But the delta, when you got the threat, became plus 35. So what you will want to do? Well, what you need to do to insert the hedge is that you need to find a way to create negative 35 delta. How do you create negative 35 delta? Well, you short 35 shares. That's what you would do if you were to approach it with stocks. But what if you don't approach it with stocks? Well, then the way to do it would be to use puts. Okay? So now, the question is, out of all the puts available here, okay, out of all the puts are on the right side, obviously, out of all the puts available here, what do? Do you buy the puts with the 35 delta? So you buy the 187.5 put if you need 35? No. First, you need to simulate the put, because again, the deltas that you see on the option chain, okay, again, if I insert this put, okay, so if I insert this put, so let me uncheck the vertical, and let's focus on the put only. This is the one I have checked. So this put have 35 delta now, but when you get to that upper point, that put will have 31. Okay, you see that? It will have 31 delta. And that's not what you want. Okay, this is absolutely not what you want. So you will want the put to be a higher put. So if I do 190, now you got 36, which is more or less okay. But what's my other problem? Okay, well, my other problem is that now if I buy a put, okay, which is a way to do it, which is cheaper than buying the stock, because buying the put would cost me. Let me bring my calculator again. Buying a put would cost me 5.05, so that's $505. Where if I was to short 35 shares at 195, I would need $6,000. If I do it in a margin account divided by 2, that's $3,400. So it's either I use $3,400 in my account, or I use 505. Well, 505 is better. So buying the put seems very appealing. But there is a catch. And the catch is that now, apart from losing $777 on theta from the call, now I am adding $12 extra on time decay. So now I am indeed being paid on time decay. And as you pointed earlier, if the stock was not to move, okay, stay very, very static there, that would really hurt the profit I have collected from 191 to 195. So how can I limit the impact of theta? Well, for me to limit the impact of theta, what I could do is go deep in the money. The deeper in the money you go, okay, the deeper in the money you go, the less the theta you get. Okay, the less the theta you get. Now, you get plenty of delta. This is way too much. Okay, way too much delta. Okay, so how would you end up doing this? Well, again, same story. You would not do this with simple options. You would do it with spreads. You would pick a deep in the money option. Okay, deep in the money option. Okay, you would right click, analyze to buy, and do a vertical. So let's take a look. So the one on the top, which is not checked, is the one with the calls. The one below, which is checked, is the one with the puts. Okay, so remember, I want the minimum theta, okay, while I want negative 35 delta, we said. Okay, and this needs to be calculated for the price where the hedge needs to be made. Okay, so not the last, but 195 in this example. Yeah, no worry, Orlando. Take care, my friend. So, so what you will want to do is, keep bringing this this put down. So if you started with 210, so keep bringing the put down. So that's 207. I'll make it 192.5. So now I got 36. Okay. So now I got more or less. Okay, I got more or less the delta I want. Okay, and this would cost me 1,138. Good news. This is much less than 3,800. Good news as well. This is paying me theta. I make $5 per day. But bad news. Okay, the gamma of this, it's negative 43. Okay, negative 43. I cannot have negative gamma positions. If I do negative gamma, I am shooting myself in the foot. The whole reason why I'm doing this is to have positive gamma. But now I just created negative gamma. What is that? What does that mean? It means that this option is too close. So I'm gonna have to move it down to 190. I'm gonna have to move it down. I can, if I do that now, I created more negative delta. So I would need just to, I would just keep working on trying to offset these situations by changing my strikes until I find a way to keep the theta, the lesser I can, to keep the gamma, the closer to zero or positive ideally, and while I find my theta, my delta, sorry, to be 35, which is what I need in this case. So if I was to do this, I have a gamma of 0, I have a theta of 3, and I have a delta of close to 33. Okay? And by the way, I should be looking at the delta here. 33. Okay? So by doing that, okay, delta of 2, delta of 33, gamma of 0. So this is going to produce the hedge I need while I get paid $2 a day, while it doesn't help, it doesn't hurt with the gamma. So if I do this together with the prior trade, okay, so now I'm reactivating the prior trade. So if I do this together with the prior trade, I end up with a flat delta, okay, flat delta, but I do have positive gamma, right? So what happens? If it goes down, I profit, right? If it goes up, I profit as well, okay? And then you would just use your rules to manage the trade to end up, in the position that you need for the trade to be properly profitable. Okay, so in other words, we will use spreads against spreads if we want to diminish the cost of the trade. The cost of the trade in this case will be 1,300 instead of 300, 800. So this is one way to do it. And the simplest way to do it, which is, to be honest, is my favorite way to do it because it's simpler, is just to short shares. Now, shorting shares takes more money. Sometimes stocks are not shortable. So then this is the alternative. It requires less money, and this you can always do it. But again, shorting shares is my favorite one because it takes no thinking, and you have less commissions to pay, less slippage to suffer, etc., etc. Okay, it's probably the most efficient way. So again, ideally, when you do this, you can do it in an account which is classified as portfolio margin. Most brokers will require $125,000, and if that's the case, you can get your account to be set as portfolio margin account, where the amount of margin needed to short or go long, it's very, very little. So I don't remember by heart, but really it's very, very little. It would probably be even less than $1,300, and now you can just do it by shorting shares, which you need no time to do that, and it's very simple to place an order to short 35 shares at 195. Okay, so anyway, guys, I will conclude the session here. Okay, today it's been a little advanced. I guess that some of you are advanced options traders, so obviously probably you follow this with no problem. For the ones that you have less experience, this probably got you thinking, so you may want to watch this again. If you are in the process of watching the initial videos, of course, you should watch them and then rewatch this one, and this should really, really help you. Okay, we will apply this starting from now on the Thursdays too. So on the Thursdays, I will give you two options, with and without the hedge. So if you want to keep it simple, I'll give you a way on how to keep it simple. If you want to keep it more advanced and evolved, you'll have a way on how to keep it advanced and more evolved. Okay, so everybody will be happy. But this is certainly powerful, guys. Okay. So anyway, let me take a look at your last questions here. John, it occurs to me that earnings is a threat where price is likely to move rapidly up or down. Is a gamma hedge before earnings? Yeah, well, the problem of doing a gamma hedge without before earnings is that after earnings, the price of the options will shrink. So the calls you own will be shrinked. Even if the stock moves your way, they will shrink in value. And if you had to put a hedge in place by using options that you bought before the earnings, those options were too inflated in value. So you would be very disappointed with the hedge and with the net result. Even if you did it with shares, meaning that you never got to buy options for the hedge, and you never suffered the extra price for the hedge because of the earnings, you still got the shrinking on the calls. Again, not ideal. So before earnings, the best thing would be just to get out, and after earnings, replan a new trade. Okay. Let me see. Yeah. Wonderful, guys. Hey, lots of fun today. Advanced session, a little longer than what I was expecting. So thanks for sticking with me. And if you had to leave, it's all good, of course. And I'm sure you'll be watching this recorded. So you guys take care. See you soon. See you on Tuesday. Next week we got 3 sessions. Tuesday, Wednesday, and Thursday. So I'm counting on you to be there. See you soon, my friends. Keep up the good work. Bye-bye, everyone.